Today, mortgage rate rises are ahead. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and prop news with a distinctively Australian flavour. Well, today I'm joined by Peter from Mozo. Hi, Peter.
Hey, Martin. How are you going?
Pretty good. Thanks very much for coming on. And day before the RBA has its meeting, you've got some really interesting data to share, and I want to pick your brains with regard to what's going on and what it all means.
Yeah, look, well, it's really hard, even just a day before the RBA meets to guess what they're going to do tomorrow. If they do decide to go ahead with an increase in the cash rate, that'll be the first time in the last 11 years. So when it does happen, whether it's tomorrow or in a month's time, this will be something very new for many mortgage holders.
I think that's a really good point to stress, which is, of course, that many people have only ever been borrowing in an environment when rates kept stepping down.
Yeah.
Right? And you probably say a lot of people assume that's the only way that mortgage rates go.
It certainly felt like it for an awfully long time now. I have some years of experience under my belt, and I used to get strange looks from people when I would talk about what mortgage rates used to be like. In some ways it's going to be gratifying to say, see, it can happen.
And it's worth underscoring, isn't it? The long-term average mortgage rate in Australia is around 7%, plus or minus.
Yeah, the rates that we've had for years now are incredibly low, and something that I've not seen in my lifetime before. The period we've been through and recently just seems so unreal to me, and in some ways it'll be nice to be getting back to some kind of normal.
Well, nice for the analysts, not so nice for many households, right, who've been lured into a relatively false sense of security. What do you sense from looking at consumers and what they're thinking?
So Mozo has recently run a survey asking consumers for how they're feeling about interest rates going up. And, we found that, there's some pretty concerning possibilities out there. So more than half of the people that we surveyed said that they hadn't even done any stress testing to see if they could afford their loan at higher rates. So I guess, it's nice to not think about such things, but, not having a plan, not knowing if you're going to be in trouble, could leave you with some awful surprises coming up over the next year.
Yes, and the concept of stress testing might seem a little alien for many, because they will say, well, doesn't the bank do that? When I make a loan application, surely the bank stress tests my ability to repay. There's that 3% buffer. So why should I worry?
Yeah, but the bank does do that, but the bank doesn't really consider, what reductions in your lifestyle you might have to make if you're going to continue to meet your repayments. And things may have changed since you went through the loan application process. So if you're in a household where one of the people is no longer earning any income or as much income as they used to, it could mean that you're financially in a very, very different situation.
Absolutely. Things do change. And I guess also banks tend to use a relatively standardized approach in terms of thinking about affordability. I mean, they do look at the income side, but in terms of the cost side of household finances, they tend to use these ratios following the Asset Westpac court case, which fell in the benefit of using ratios. But of course, there is a big assumption there that people are actually behaving like those ratios. And my own observation is those ratios are actually really, really quite slight when it comes to the real spending programs of many households.
Yeah, they're not always very realistic. They're very finger in the air kind of estimates. But I think the other factor that we've got to take into account at the moment is, the RBA is being pushed towards taking action because of the very high CPI. And that means that, costs are going up, and they're real things like, power bills, fruit and vegetables. You've got to be able to feed your family, and things are getting tighter at the moment. So adding increased interest costs to your household bills is going to be really tough for a lot of people.
And of course, worth reflecting on the fact that incomes in real terms are not increasing, particularly now with inflation so high. So if you think about trying to square the circle, you've got costs going up, you've got mortgage rates going up, you've got incomes flat or falling. Not too much surprise then that this is actually quite a tricky time.
Yeah. And we did ask people, how much of an interest rate rise would it take for you to start feeling in some financial stress? 8% of respondents to our survey said that any increase in mortgage rates would put them under financial stress. And if rates go up to the 5% mark, so that's mortgage rates go up to 5%, which is not out of the question, almost 2/3 of our respondents said that they'd be in financial stress. That's a huge number.
It is, absolutely. Well, I do my own financial flow stress surveys, and at the moment, about 1.5 million households have cash flow issues. They're getting by, but only just. But if rates went up another 2%, that would be almost another 500,000 households added to the list, which is more than half of all households. So it's interesting that your data and my data independently highlights the same problem. If rates go up, this is going to create pain.
Yeah, it is. And, these sorts of figures don't even include things like, people who might be on a very low fixed rate now, rolling off that fixed rate in 6 months, 12 months' time, and finding that they're going to have to pay something like perhaps double the interest rate that they've been paying over the last year or two. So there's a whole lot of issues being backed up, and that will start to unravel over the next year or so, just when the RBA is putting up rates.
So do you think this will force the RBA to come back and revise what it's going to do with regard to rates, or even another term funding facility to offer really cheap money to the banks to be able to offer cheap loans? Or do you think the banks might actually do what they did through COVID and say, well, we'll restructure your mortgage to make it longer and skinnier and therefore more easy to service? Are we going to see some of that, do you think?
Oh, look, I think the banks are a bit more amenable to helping their clients out these days after the Royal Commission into banking. That certainly got them on board with putting customers first, or at least giving customer needs a higher priority, and recognising that putting people into a financial crunch situation is not helpful for anyone. However, if things do get out of hand, I don't think that the banks are going to be able to do a whole lot, and we may find ourselves, just dealing with a traditional housing crash.
Right. So falling prices at the time when people need to sell, many people with big mortgages and therefore potentially negative equity scenarios. None of that looks pretty. Now, people will say, well, hang on a moment, there are lots of buffers out there. Many people have got huge amounts of savings and, the COVID stimulus, and, they've paid ahead and everything's fine. So what's the true story in your view about this buffers argument? Because I hear it all the time from the Reserve Bank, from politicians, but I'm not sure it tells the full story.
No, it doesn't. There are people out there who have buffers. They've built up lots of equity. They've got money in offset accounts. But there are also plenty of people who've been encouraged to enter the market over the last couple of years while rates are really low, with government assistance in a lot of cases. So they're going to find this a very large adjustment to go through. And, if they've bought in the last couple of years, they've paid high prices at the top of the market. And with prices, as you say, potentially coming down over the next year or two, they're really going to struggle to get back the money that they've put into their house.
And so what the implication there is that whilst, of course, the government will talk about Ukraine, oil and all those international situations and the international trends on inflation, some of recent government policies pulling people forward into the market with first home homeowner grants and home builder, all that sort of thing. That is part of the reason why we had that massive spike up in prices.
Yeah, and all of these things sound like great ideas at the time, and it sort of brings to mind the recently announced Labor policy to share equity in a home. It's great to help people out, but if people can't afford to buy into the market, I really wonder about the longer term value of giving them that leg up, inflating the market further, and just perpetuating the problem of an overinflated housing market.
It was interesting. I saw somebody today saying, you realise that the Labor policy is the equivalent of the government giving people on average 6 years of annual income on a standard, normal income. 6 years of income, basically, is what they're actually offering. So taxpayers, we are helping out. so you've got to say, the more that these markets get distorted by these sorts of policies, the more complex it becomes and the more likely is we're going to get more unintended consequences.
Yeah, and look, I'd rather see Labor do something for people who genuinely cannot afford to keep a roof over their head, rather than people who have enough money to have choices about how they put a roof over their head.
Good point. So as we come to the end of this conversation, what should households then be doing, right? So they've got a mortgage, they're conscious now that rates are likely to start rising ahead. Are there things they should be doing now?
Look, I think there's a couple of things that people can do. Make sure you know what interest rate you're on right now. Check your statements, check with your bank, find out what rate you're on. Compare it with other lenders. See how your lender is sitting in the market generally. You could be overpaying, you could be on a great rate. But if you are overpaying, getting the best rate you possibly can will cut your bill. And even if that lender does increase rates along with everyone else tomorrow or in 4 weeks' time, they will still have a better rate. And while small differences in interest rates seem fairly trivial, over many years, those differences can add up really quickly and mean the difference between paying a reasonable amount on your mortgage and overpaying by quite a lot. And anything you can do to cut down that interest bill will cut your monthly bills.
That's right, the old compounding effect, right? So effectively, if you reduce the interest rate, then the interest on interest gets taken down a bit, and that actually reduces the overall amount, which means you're paying more of the capital back rather than just paying the interest rate back. And I'm still amazed, Peter, I don't know whether you see it, but I see it. A lot of people don't know what their mortgage rate is. And even when they know that there are better rates around, they think it's too hard to shop around and find out what the alternatives are, which I find very surprising.
Yeah, if you're talking about even a few $1,000s every year, surely that's worth taking a day out of your year to address. And particularly if it's setting you up for having better rates for the next few years.
Absolutely. And of course, Mozo has a very good comparison site. There are others there, but Mozo's got some really good information and very easy to navigate. So I recommend going and having a look. And I guess the last question as we come to here is, what about deposit rates? Do you think they're going to go up, or do you think that the banks will be stealing the margin?
So I think we're already seeing term deposits jumping up quite sharply. So particularly for longer terms, but even shorter terms, the best at call deposit rates, unless you're in the 20 to 30-year-old market where banks are, offering 2% in a lot of cases. For everyone else, the top rates are about 1.35%, and there's only a couple of options there. Term deposits for a year are jumping up, and they're pushing up towards 2% now. So even if you don't want to lock in long term, you can get really good term deposit rates. If you want to go for something like 5 years, if you're feeling lucky, the rates are pushing up towards 4% at the moment. So that's so much better than those at-call rates. Term deposit rates have been hard to recommend for a long time now. But the way things are at the moment, there are a few players out there who are really fighting to get the best rates in the space. So I'd have a look at places like Judo Bank and AMP. They're not massive names, but they're big companies and well worth having a look if you've got got some funds that you want to put somewhere for a while.
Great thought there, because of course a lot of people got to the point where they said, well, I never earn anything on money sitting in the bank, I just don't worry about it. Well, maybe you should worry, because there are now alternatives. And again, going back to, stress is money in, money out. If you can get a little bit more money coming in because of higher interest rates and returns on deposit, that's useful. As well as if you can reduce your mortgage repayments by simply going to a lower rate mortgage, that's also useful. And, my perspective, Peter, is now is the time to be proactive. Check over your finances and see what you can do to pull those levers. I guess the other point is it's also just worth thinking about what you're spending your money on, and are there things that really, are, well, discretionary, sure, but not necessarily required. I'm thinking of many streaming services that people seem to end up with. Well, maybe there's a time to prune some of those too.
Oh, for sure. Each of them only costs a little bit, but when you add them up, I don't know if you look at your bank statement and think, oh, wow, how could I have spent so much in the last month when, I haven't gone out and bought anything. It's just these regular subscriptions that we're becoming so used to having and so used to paying for. If you can chop off even a few of those, it'll certainly add up and help to keep money coming in for the bills.
And just to say, of course, that it's very, very easy to subscribe to these things. It's quite a lot more complicated to cancel the subscription sometimes, so you have to go through the right process. But it is worth understanding what you've locked yourself in for. And I'm still surprised when I survey my households that a lot of people don't have any sense of where the money goes each month. They've got real, they've got just a sense of, well, I've got this coming in roughly. I know roughly what I've got left at the end of the month, but as to where it's gone, I've no real idea.
Yeah, and I think just the old saying about look after the cents and the dollars will take care of themselves is so true. It's about doing all those little things, and over time they add up. So look after your debts, trim them down, cut your expenses, and save as much money as you can every chance you get. And you'll end up ahead at the end.
Great advice. I know it sounds a bit boring because, people just want to go and sort of splurge all the time. But sometimes, pulling back and just asking these questions is really important. Peter, I really appreciate your time today. It'll be very interesting to see what the Reserve Bank says tomorrow and what it does tomorrow. And I'm sure we'll chat again down the road and see where rates end up.
Yep. Look forward to talking again.
Thanks. See you. Bye.